another week of Equity Mates. My name is Bryce, and as always, I'm joined by my equity mate, Alec. Happy Super Bowl Monday.
Thanks, Bryce. Great to be here. Feeling good to be back for another week. Probably not feeling as good as Tom Brady's feeling right now.
The Big Seven.
Yeah, the Big Seven.
How good. Pretty impressive scenes over in America, and that is going to be the theme of our episode today. We're going to be diving into some of the impressive results that we continue to see from earnings seasons over in the US, with obviously the tech companies leading the way, and also, I guess, some of the Patrick Mahomes companies, should I say.
How far can you stretch this metaphor?
Those companies that have disappointed over in reporting season. So looking forward to kicking it off, Ren.
Yeah, can't wait. And look, we don't want to rehash old news, but we can't go past the big tech companies. Nothing has been more impressive than some of the results we've seen from really the big three.
Yeah, so we have Apple, obviously just continuing to impress, Amazon, and a couple of others that we'll dive into. So let's start with Apple. Very impressive top line result, revenue of $111 billion, Ren, up 21% year on year. Phenomenal.
Yeah, first time they cracked $100 billion revenue in a quarter on the back of really strong iPhone 12 sales. As someone who personally upgraded,
nice.
I like to think that I contributed to that. But also, you can see the services business that they're trying to build out, really impressive growth, or continued growth in Apple's services business.
Yeah.
I think we've got a chart here that you can see just that steady increase in that new business line.
Yeah, $65 billion coming from iPhone revenue. To your point, Ren, services $16 billion. And also the wearables and home and accessories part of the business we can't forget, also contributing $13 billion there. So pretty impressive. $100 billion for the first time, as you said. When will they hit the 150? Can't be far off.
Can't be far off.
Market cap of $2.3 trillion. So I remember one of my bold predictions, though, Ren, for the year was market cap for Apple at the end of this year of $3 trillion, off the back of what I believe will be further penetration of their services or recurring revenue. So looking forward to see how they report throughout this year.
There you go, big prediction.
Big prediction, $3 trillion market cap. Let's move on. We've got our second company here, and that is Microsoft.
Yeah, another company that has had a record-breaking quarter. So they broke the record for revenue. They broke $40 billion for the first time, and also for profit, breaking $15 billion in profit for the first time in a quarter.
Yeah, pretty amazing. Revenue up 16% year on year, so they continue to impress. The standout, though, Ren, is the Azure cloud computing segment, which has grown revenues 50%, which is pretty phenomenal given the competition that they are up against with AWS over at Amazon. Can't really complain with what's going on at Microsoft.
Yeah, another impressive quarter and just a phenomenal company that just keeps doing it.
Yeah, and their CEO, Satya Nadella, has come out to say that they are just seeing another wave of companies go through this digital transformation, and obviously they have set themselves up incredibly well to, I guess, be part of the tailwinds and help businesses digitally transform. So pretty impressive. But then Amazon.
Apple had come out and, people were saying best quarter in the history of capitalism, all that stuff, broke $100 billion in revenue for the first time. Amazon said, hold my iPhone.
Too bad. Yeah, too bad. We've just come out and smashed Apple, and revenue of $125 billion in the first quarter for them, up 43%. I mean, as a shareholder, you just have to be, I guess, happy that they can continue to have such impressive results. But Apple were probably cheering, and Amazon's just come and taken away the limelight. So pretty phenomenal there. But Bezos
stepping down. Taking the company from, that one-room office in Seattle. You see the memes of it, the spray-painted Amazon sign, to a $1.7 trillion company, offices around the world, businesses around the world. One of the best businessmen of our lifetime.
Absolutely.
But he's stepping down.
Yeah, stepping down to focus on some of his other businesses. He's got his, obviously, space business that he's looking at. He's involved in his own investment holding business and focusing on his fund as well. So It'll be interesting to see how the company performs. The CEO taking over was the CEO of the AWS, so perhaps it's an indication of where they want to be taking that business. But I've just got a list of things here, Ren, that they pioneered on the internet that is worth sort of chatting about. Customer reviews, you would say that they were one of the pioneers for one-click, personalized recommendations, obviously Prime shipping, which was pretty phenomenal. If you just think about what Bezos has achieved over the last sort of 20 years, he's absolutely led the way. So,
did he pioneer customer recommendations?
Well, yes.
Okay.
Yes.
Yeah. Or reviews? No, there were reviews before.
There were reviews, but I think he's made it into, I guess, something that all other e-commerce businesses now heavily rely on as well.
Yeah. Look,
we'll take it up with Jeff.
You don't need to stretch the truth, because the truth is impressive enough as it is. An incredible business. I think one thing, if we're talking about Amazon and we're talking about Microsoft, the competition in the cloud computing business is a really interesting one to watch. AWS is bigger, but Azure grew faster this quarter, 50% compared to 28%. So that'll be a really interesting business competition to keep watching, especially as Amazon pivot more to that part of the business with Andy Jassy taking over as the CEO.
Yeah. So 3 pretty impressive results, obviously from 3 of the largest tech companies in the world. We love sort of continuing watching these guys just put record after record. But Ren, I guess one of the key takeaways we have here is the impact it has on valuing these companies and destroying your classic DCF model.
Yeah, well, this was, as I was looking at these companies, I was just thinking, if you think about your basic discounted cash flow, you say, at some point in the future, it becomes so uncertain that we can't forecast, 10 years out what their growth rates will be. So we'll just have a term, we'll just put inflation. The terminal growth rate will just be inflation. These companies have all been around for over 20 years, 25 years, some longer than that. They're not hitting the growth at a rate of inflation. These tech companies are growing at an incredible clip, 30 years after they were founded in some cases. So I don't know, what do you do when you're trying to discount the value of future cash flows back when they just seem to be perpetual growth machines these days?
Yeah, I mean, it's incredibly difficult to do, and as a beginner investor and you're, I guess, coming across the DCF for the first time, and traditionally you're putting in conservative growth rates around 8-10%, and these guys just keep punching it out, hitting it out of the park. It is incredibly difficult to do, and I guess that's why, from a value point of view, there's that argument at the moment around value versus growth and where do these companies sort of fit and how do you make investing decisions and also value companies like this. But I've thrown the DCF out the window when it comes to these guys.
You could never do a DCF in the first place.
That is not true. Not true. Anyway, moving on, Ren, we should chat about some of the companies that didn't perform so well. And they are some pretty sort of significant names. These aren't names that no one would have heard of. But there are some reasons, I guess, as to why they're not performing. So let's start with Boeing.
Yes.
Tough.
Certainly
not
time.
Flying.
No. Yeah, Boeing had a really tough 2020 on the back of a bad end to 2019. In 2020, they delivered 157 jets, down from 806 in 2018.
Wow.
So, on the back of the 737 MAX issues with the planes crashing, the 787 Dreamliner production flaws, COVID-19 slowing the air travel industry down, Boeing is not delivering.
Not doing well.
Yeah.
15% revenue fall, operating loss of $8 billion, loss per share of $15.25.
Yeah, and analysts, the market was expecting a loss per share of about $1.80. So that loss per share of over $15 was a shock.
Absolutely got hammered.
Yeah.
We'll chat about that in a second, but Harley-Davidson, now they also didn't have a very good result. Revenue of $530 million. Analysts were expecting about $770 million, so they didn't perform very well. But the reason we sort of picked this one up is because they're obviously at the tail end of one 5-year strategic play and are about to kick off their next 5-year strategic play, and they have renamed them the Rewire. and the hardwire, which I found sort of funny. The rewire was all about stripping costs. They did manage to strip out 115 million in costs from the business, but they've named the next 5 years the hardwire. So can they turn things around? Who knows?
I just want to say, if there's any companies out there trying to name their new 5-year plans, come to Bryce and I reckon we can do better than what Harley-Davidson has done.
The rewire and the hardwire. And then to close it out, Ren, one that has been obviously hot recently, and that is Tesla, but their performance or their reporting though didn't meet expectations.
Yeah. So the big story about Tesla. I mean, you strip away all the hype around the share price growth, Elon Musk being in the news constantly. Will it crack $1 trillion at some point? All of those headline-driven conversations. At the end of the day, it's a car maker, and it's got to make these cars profitably. And the big story that came out of this reporting season was, on the positive side of the ledger, it had its sixth consecutive quarter of profitability. Not bad, you'd take that. Earnings per share were down from about $2 a share to about 80 cents, but still, it's consistently making a profit now. But on the other side, the other part of the story is its margin. So its margin was down from about 9% to about 5%. I think a lot of that came from cost pressures in China. But that's going to be the story to watch, I think. Can Tesla keep a positive margin? Can they grow their margin as they grow their scale? Because every legacy car maker is entering the electric vehicle space. There's going to be cost pressure and there's going to be competition heating up. We saw Will Ferrell do an ad for GM during the Super Bowl today about GM's move into electric cars. They want to have like 30 cars or something on the road by 2025. There's going to be a lot more competition in this space. Consumers are going to have choice. They'll be more cost sensitive. You don't want to see Tesla's margin continue to erode.
Do you think, though, that shareholders will mind that if they continue to, I guess, dominate market share in the electric vehicle space? Like, should they be able to maintain or improve market share if their margins slide? Is that something shareholders would be willing to, I guess, offset?
Well, yeah, of course, for a short period of time, and that's the classic story we hear about tech companies now.
Exactly.
They price their products free or at a very big discount. They lose money for a while. They capture massive market share, and then they have the pricing power to increase their prices. I would say that there are some reasons why car companies don't work the same as tech companies. It's not like you can get a dominant network effect by having 70% market share and then that sort of gives you a defensible moat. When consumers are making a decision about what car to buy, they're not locked into the car they bought 5 years ago or something like that. So I think Tesla needs to have positive unit economics. They need to be able to sell their cars for a profit now and into the future. So that'll be a story to watch.
Well, as always, Tesla in the news for some reason. It'll be interesting to see how that pans out over the next quarter or so. But Ren, before we finished, I know you had a comment around the Boeing piece.
Yeah, I don't know why you kept it to the end. It's almost like you were trying to avoid it and trying to run the clock down, just like Tom Brady did in the Super Bowl. Boeing, terrible 18 months. It was a company that has had terrible product problems. It's obviously then been impacted by the macro environment with COVID. It was a company that, they talked about those companies that were doing a lot of taking out debt to buy shares back and a lot of financial engineering there, a lot of controversy around Boeing.
Yeah.
At the same time, an incredibly important strategic asset. Yeah. It's in this duopoly of plane makers. The US government won't want to cede a lot of market share to the European Airbus. Mm-hmm. So company in a lot of strife, but incredibly strategic asset. Buy, hold, or sell Boeing?
For me, it would be a sell, I think. I don't own it, and I think that just because it's backed, has a strategic interest from the US government for it to maintain its position, I guess because it's to do with military. For me as a shareholder, I don't see any value if it's, as you phrased it, a pretty poorly run company and one that I don't really see has strong tailwinds behind it. So, self-made. What about you?
In an episode of terrible puns, we managed to sneak one more in there.
What about you?
I mean, I would have to agree. we obviously aren't experts in the aeronautics industry,
No.
but it's pretty difficult to see a good case for Boeing. The opposite side of the argument is that the US government will bail them out. And the US government were preparing to bail them out in March of 2020. They'd gone to the US government to ask for money. Then the Fed pumped a whole bunch of liquidity in the bond market, and then they could go to the bond market and raise debt instead. But it feels like, the US need domestic plane manufacturing. So Boeing probably isn't going anywhere, but it's not going in my portfolio.
Yeah. Well, that brings us to the end of Equity Mates for today. We hope you managed to get something out of it that helps you on your investing journey. And Ren, tomorrow we are talking all things ETFs.
Can't wait.
We are bringing in an expert from BetaShares and talking about the ETFs that will matter through 2020. So Ren, very much looking forward to it.